Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 119, and in this episode we're reviewing the performance of the global markets during the 31st week of 2024, and that is from Monday the 29th of July to Friday the 2nd of August. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where on Wednesday, the Federal Reserve held its benchmark interest rate steady, but indicated that inflation was getting closer to its target rate, which could open the door for future rate cuts. The Federal Open Market Committee, however, made no obvious indication that a rate cut was imminent and instead opted to focus on concerns about economic conditions as they continue to maintain that more progress was needed before they could initiate any rate cuts. However, at the press conference, the Fed chairman appeared to rule out the possibility for a larger rate cut of 50 basis points, but indicated that a rate cut in September was on the table as long as the inflation data continues to support that decision. And staying in the United States, on Friday, the Labor Department reported that growth in U.S. jobs slowed down more than expected during the month of July as the unemployment rate ticked higher, fueling concerns about a broader economic slowdown. Nonfarm payrolls, which measures the number of new jobs excluding farm workers, grew by 114,000 new jobs in the month of July, and this was down from a revised number of 179,000 jobs in the month of June, and was below the Dow Jones estimate for 185,000 new jobs. Meanwhile, the unemployment rate ticked up higher to 4.3%, which is the highest unemployment rate since October 2021. The labor market has been a key pillar of the U.S. economy, but has recently shown signs of weakness, with the July number coming in well below the average of 215,000 new jobs over the past 12 months. Across the pond in the United Kingdom, on Thursday, the Bank of England delivered its first interest rate cut in more than 4 years, reducing its benchmark rate by 25 basis points to 5% flat. Policymakers voted 5-4 in favor of the reduction, with Governor Andrew Bailey saying that the committee would move ahead cautiously after holding the benchmark rate at a 16-year high since August 2023. A lack of clear signaling from the Bank of England raised uncertainty about this decision, as markets were pricing in about a 61% probability for a 25 basis point reduction in the key rate. In response, the yield on UK gilts, that is UK government bonds, slipped as markets began digesting the policy decision and the outlook for interest rates. The yield on the 10-year gilt was down by over 9 basis points to 3.88%, whilst the yield on the 2-year gilt tumbled more than 10 basis points to 3.70%. And in the larger Eurozone area, according to data released by Eurostat on Wednesday, headline inflation in the Eurozone unexpectedly rose to 2.6% in the month of July. Economists polled by Reuters had expected the headline inflation number for July to remain at the same rate as June's reading of 2.5%. Meanwhile, core inflation, which excludes volatile food and energy prices, came out at 2.9% in July, compared to a Reuters estimate of 2.8%. In the land of the rising sun, Japan's central bank raised its benchmark interest rate to around 0.25%, up from the previous range of between 0% to 0.1%, and outlined its plan to taper down its bond buying program. The Bank of Japan said it will continue to raise its policy interest rate and adjust the degree of monetary accommodation, assuming its economic outlook is realized. The Bank of Japan said that it will maintain its monthly purchases of Japanese government bonds to about 6 trillion yen per month until the first quarter of 2026. On Wall Street this past week, stocks fell sharply on Friday as a weaker-than-expected jobs report ignited concerns that the U.S. economy could be sliding into a recession. Stocks sank after the July jobs report slowed down more than expected, whilst the unemployment rate rose to its highest level since October 2021. The broad market index, that's S&P 500, dropped by 1.84% to end at 5,346, whilst the Nasdaq Composite lost about 2.4% to close at 16,776, as the tech-heavy index recorded a decline of more than 10% from its recent all-time record high of 18,647. Meanwhile, the Dow Jones Industrial Average fell by 610 points to finish off at 39,737. And just for your information, a decline of more than 10% is considered a correction, which means that the Nasdaq has now entered correction territory as it has declined more than 10% from its record high. In the U.S. bond market, U.S. Treasury yields were sharply lower on Friday after a weaker-than-expected jobs report raised concerns that U.S. economic growth was slowing down. The yield on the 10-year Treasury fell to its lowest since December 2023 as investors fled to the safety of bonds on concerns that the Federal Reserve had made a mistake by keeping interest rates on hold this past week. The yield on the benchmark 10-year Treasury bond was down more than 17 basis points at 3.79%, whilst the yield on the policy-sensitive 2-year Treasury note dropped by about 28 basis points and was last seen trading at 3.88%. According to the CME FedWatch tool, the markets are now pricing in a 70% likelihood for a 50 basis point rate cut in the month of September. For your information, bond yields and prices have an inverted relationship, and 1 basis point is equivalent to 0.01%. In the commodity markets, the price of crude oil fell nearly 3% on Friday after a weaker than expected jobs report raised renewed concerns about an economic recession in the United States. According to market analysts, despite escalating tensions in the Middle East that could disrupt oil supplies, the prospect of weak economic growth in the major economies looms even larger and could suppress the demand for crude oil. Economic data shows weaker manufacturing activity across Asia, Europe, and the United States, and this has raised the risk of a slowdown in the global economy. The price of the U.S. benchmark, that is West Texas Intermediate crude, fell by 3.6% to settle at $76.81 a barrel. Meanwhile, the price of the international benchmark, Brent crude, dropped by 3.4% to settle at the same price of $76.81 per barrel. For the week, the price of WTI dropped by 4.7%, whilst Brent pulled back by 5.3%. In the precious metals market, the price of gold retreated on Friday as profit-taking kicked in following an initial spike of more than 1% earlier in the session. During the week, the price of gold gained about 1.8%, driven higher by safe haven demand due to the escalating tensions in the Middle East, as well as expectations that the Federal Reserve could start cutting rates as soon as September. The market is now factoring in a better than 70% chance for a 50 basis point rate cut at the Fed's policy meeting in September. The price of gold is traditionally considered a hedge against inflation as well as geopolitical risks, and lower interest rates tend to reduce the opportunity cost of holding this non-yielding asset. The price of spot gold fell by 0.5% and eventually came to a close at $2,432 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country. According to the Kenyan National Bureau of Statistics, overall inflation declined to 4.3% in the month of July, down from 4.6% in June, and this was mainly driven by lower energy prices. This rate of inflation marks the lowest rate since September 2020, when inflation stood at 4.2%. Food inflation remained unchanged at 5.6%, whilst fuel inflation declined to 4.5%, down from 6.4% in June, and this was mainly due to lower electricity and petrol prices. Meanwhile, core inflation, otherwise known as non-food, non-fuel inflation, this moderated to 3.3%, down from 3.4% in June, reflecting the impact of monetary policy measures adopted by the central bank. In the domestic foreign exchange market, during the past week, the Kenyan shilling appreciated significantly versus the US dollar and once again broke below 130 shillings. According to data obtained from the Central Bank of Kenya, the official exchange rate for the US dollar was quoted at 129.15 compared to 132.22 the previous week. However, in the interbank market, commercial banks were selling the US dollar within a narrow range of between 131 to 133 shillings. The lowest rate was offered by Stanbic Bank at 131.50, whilst the highest rate was quoted by NCBA Bank at 133 shillings flat. Meanwhile, the sterling pound was priced at 165.80 and the euro was valued at 140.05. And on the regional front, one Kenyan shilling was changing hands for 28.81 Ugandan shillings and 20.92 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.17. The shilling now appears to be relatively stable against the US dollar. However, that does not negate the fact that Kenya's underlying economic fundamentals remain extremely weak, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. And given these fundamentals, I expect that the shilling will continue to remain under pressure for the foreseeable future until such a time that we get our national debt under control. But as we all know by now, there are no solutions to excessive debt, just consequences in the form of higher taxes. On foreign exchange reserves, Kenya's usable foreign exchange reserves decreased by $37 million to $7.27 billion, which is equivalent to 3.8 months of import cover. This level of reserves falls below the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing national debt that has pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and was well supported through open market operations, with the interbank rate, which is the rate that banks lend to each other on an overnight basis, remaining relatively unchanged at the same level of 13.19% that was recorded the previous week. On the back of that, the average value traded in the interbank market increased to 35.3 billion shillings, up from 21.9 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement stood at 19.3 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the first day of August, and the central bank received bids totaling 24.4 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 102%. The central bank ended up accepting 23 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 2 basis points to average out at 15.98%, whilst the 182-day rate stayed put for the second week in a row at 16.85%, and the 364-day rate followed suit as it maintained the same rate of 16.92%. And just as a reminder, the Central Bank of Kenya has published its prospectus for its August bond issue, in which it is looking to raise 50 billion shillings for the stated purpose of funding infrastructure projects. In this regard, the central bank is offering for sale two reopened infrastructure bonds whose terms and conditions are as follows. The first bond is IFB1/2023/6.5. This bond has 5.8 years left to maturity and a coupon rate at 17.93%. The second bond is IFB1/2023/17. This bond has 15.7 years left to maturity and a coupon rate at 14.39%. These bonds are now open for sale until Wednesday, the 14th of August. In the secondary bond market, the turnover in the domestic secondary market increased by 21% during the past week. And in the international bond market, during the month of July, the yields on Kenya's Eurobonds were on an upward trajectory, with the yield on the 7-year 2019 Eurobond increasing the most by 50 basis points from 10.1% recorded at the end of June to 10.6% that was recorded at the end of July. And during the past week, the yield on the 30-year 2018 Eurobond increased the most by 30 basis points from 10.8% recorded the previous week to 11.10%. At the Nairobi Securities Exchange, during the month of July, the equities market was on a downward trajectory, with the NSE 10 declining the most by 1.7%, whilst the NSE 25, the NSE 20, and the NASI declined by 1.6%, 1.3%, and 0.8% respectively. The market's performance was driven by losses recorded by large-cap stocks such as Safaricom, Equity Bank, and Standard Chartered Bank, which declined by 8.1%, 4.1%, and 3% respectively. These losses were, however, mitigated by gains recorded by other large-cap stocks such as Bamburi Cement, which recorded a massive increase of 48.3%, whilst East African Breweries and Stanbic Bank recorded modest gains of 7.7% and 1.5% respectively. And in related news, in the past 9 weeks, the Nairobi Securities Exchange has shed about 174 billion shillings, and this is on the back of anti-government protests and a rating downgrade that has seen foreign investors turn into net sellers. The dip in market capitalization has been attributed to anti-government protests, as well as the decision by Moody's to downgrade Kenya's credit rating after the withdrawal of the finance bill for 2024. And in the financial headlines this past week, Moody's downgraded the rating of 3 Kenyan banks, namely Kenya Commercial Bank, Equity Bank, and Cooperative Bank, and in the process cited the weakened credit profile of the Kenyan government. The rating agencies say that the downgrade was attributed to the bank's high exposure to domestic sovereign debt in the form of government securities. And in addition to that, on Saturday, Fitch became the second major rating agency to downgrade Kenya's credit rating. Following a similar downgrade by Moody's in July, Fitch has now cut Kenya's credit rating further into junk territory with a rating of B-, but with a stable outlook. This signals that Kenya is now more likely to default on its external debt obligations, especially after the withdrawal of the finance bill for 2024 that would have raised an additional 346 billion shillings in revenues. Up next is our topical issue, and this week we are looking at the implication of the court's decision to declare the Finance Act 2023 as unconstitutional. On the 27th of June, after weeks of violent protest and national unrest, the president finally bowed down to public pressure and withdrew the finance bill for 2024. And just as the government was reverting back to the finance bill for 2023, Murphy's Law kicked in this past week as the Court of Appeal delivered the knockout punch when it ruled that the Finance Act 2023 was fundamentally flawed and was therefore void and unconstitutional. This ruling will have far-reaching consequences for both the government and the country. However, the most immediate implication is that the government will now have to revert back to the Finance Act for 2022 in order to finance its budget for the current financial year. By declaring the Finance Act for 2023 as unconstitutional, the Court of Appeal has effectively nullified the continued implementation of taxes that were introduced through this act. Some of the taxes that have been nullified include the standard rating of value-added tax on petroleum products to 16%. This now reverts back to the previous rate of 8%. In addition to that, the increase in payroll taxes to 32.5% for those earning between 500 to 800,000 and 35% for those earning more than 800,000 per month. This now reverts back to the previous tax rate of 30% flat. However, a notable exception to the rule is the Affordable Housing Levy, which remains in force due to the passage of the Affordable Housing Act, which was assented into law on the 19th of March 2024. The judgment issued by the Court of Appeal was also extremely consequential in determining how public participation will be conducted going forward. The court stated that even though the Finance Act for 2023 was subjected to adequate public participation, Parliament failed to provide reasons for why it accepted or rejected views from the public. And appearing to add fuel to the fire, the decision to void the Finance Act 2023 has left the government with an additional budget deficit of 510 billion shillings for the current fiscal year. This deficit was revealed on Friday when the National Treasury filed a notice of appeal at the Supreme Court. In its appeal, the Treasury stated that it stands to lose 164 billion shillings in revenue if the provisions of the Finance Act 2023 are removed from the country's tax laws. This amount of 164 billion shillings would be in addition to the current shortfall of 346 billion shillings, which is the amount in new tax revenues that was lost due to the withdrawal of the Finance Bill for 2024. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhurij jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, I can't believe what you say because I see what you do. A quote by James Baldwin. Think about it. Thank you, and God bless.